What is going on, everyone? It is your boy, Mr. AG here, and you are watching the most critical gold and silver breakdown of the entire week. Because what happened in the last 48 hours is going to completely reshape how you think about precious metals, and I guarantee you that 95% of investors watching the mainstream financial news have absolutely no idea what actually just occurred. It is Tuesday night, March 10th, 2026. And today we witnessed one of the most powerful reversals in the precious metals market that I have seen in months, and the story behind this move is so much bigger than what CNBC or Bloomberg is telling you. Before I get into the data, I need you to smash that subscribe button right now and hit the notification bell, because I put out precious metals analysis every single day, and if you are not subscribed, you are going to miss the updates that actually matter. And while you are at it, drop a comment and tell me where you are watching from tonight. Are you tuning in from Asia? From the Middle East? From Europe, America, Australia? I want to know where the Mr. AG community is located, because this channel is growing fast, and I want to connect with every single one of you who is paying attention to what is really happening in these markets. Now let me hit you with the standard disclaimer, because I have to say this. This is not financial advice. I am not a licensed financial advisor. I am just an Asian guy who spends way too much time reading production reports and central bank announcements and connecting dots that the mainstream media refuses to connect. Do your own research. Make your own decisions. Consult a professional if you need to. But understand that I am going to show you data today that the financial establishment does not want you to see, and you need to decide for yourself what it means. Let me tell you exactly what happened today, because the numbers are absolutely insane. Gold spot price closed at $5,228.40 per ounce, up $124.70 in a single session. That is a 2.44% move in one day. Silver spot price closed at $89.81 per ounce, up $5.28, which is a 6.25% single-day gain. Let me repeat that. Silver moved over 6% in one trading session. That is not normal. That is not a random fluctuation. That is a market that is trying to tell you something, and if you are not listening, you are going to get left behind. Now here is where it gets really interesting. On Monday, just yesterday, gold dropped 1.5% to $5,091.62. The mainstream financial media was all over it. CNBC ran headlines about gold slipping on a stronger dollar and higher rate expectations. The narrative was that the Middle East crisis was actually bearish for gold because it was driving oil prices toward $120 a barrel, which was stoking inflation fears, which was pushing out Fed rate cut expectations, which was strengthening the dollar, which was pressuring gold lower. That was the story they wanted you to believe. That was the narrative they were spinning to shake you out of your positions. And what happened the very next day? Gold ripped $124 higher and completely erased the entire loss, and then some. Silver exploded 6.25%. The exact same crisis that they told you was bearish for gold on Monday became the catalyst for one of the strongest single-day rallies we have seen this year. So either the mainstream financial analysts are completely incompetent or they are deliberately misleading you. I will let you decide which one it is. Let me explain what I call the Strait of Hormuz paradox, because this is the key to understanding everything that is happening right now. The Strait of Hormuz is one of the most critical choke points in the entire global economy. Roughly 20% of the world's oil flows through this narrow passage between Iran and the Arabian Peninsula. When the US and Israeli strikes on Iran effectively disrupted this region, oil prices spiked toward $120 a barrel. The immediate market reaction was dollar strength, because higher oil means higher inflation, which means the Fed keeps rates higher for longer, which supports the dollar. And a stronger dollar typically pressures gold lower. That is what happened on Monday. But here is what 95% of investors missed. The same geopolitical crisis that temporarily strengthened the dollar is simultaneously accelerating the de-dollarization trend that the World Gold Council has identified as gold's primary long-term structural support. Central banks around the world have been watching the United States weaponize the dollar through sanctions. They have seen what happened to Russia's foreign exchange reserves. They understand that holding dollar-denominated assets makes you vulnerable to having your wealth frozen if you fall out of favor with Washington. And every time there is a major geopolitical crisis, every time the US flexes its financial power, these central banks accelerate their diversification into physical gold. So Monday's drop was a technical dollar reaction. It was not a fundamental shift. And Tuesday's explosive rebound confirms exactly that. The Asian central banks and retail buyers who absorbed Monday's dip are already in profit. The weak hands who sold on Monday are watching the price rip higher and regretting their decision. This is how wealth gets transferred from the impatient to the patient, from the emotional to the analytical, from the people who trust headlines to the people who understand fundamentals. Now let me talk about silver specifically, because the 6.25% move today is telling us something extremely important about the supply situation. The gold to silver ratio tightened to 58.2 on Tuesday. For those who do not know, the gold to silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged somewhere between 50 and 70 over the long term, but it has been as low as 15 during major silver bull markets. At 58.2, we are in a range that many seasoned physical investors view as historically compelling in silver's favor. Silver is still undervalued relative to gold, and the ratio is tightening, which suggests that silver is starting to outperform. And the supply picture for silver is getting worse, not better. Fresnillo, the world's largest primary silver producer, just announced that they project lower silver production ahead. Their silver output was 48.7 million ounces in 2025, which was in line with guidance, but down 13.5% year over year. The largest silver miner on Earth is producing less metal than they did last year. And this is not a temporary issue. This is a structural decline driven by falling ore grades and rising extraction costs. The easy silver has been mined. What remains is harder to extract, more expensive to process, and requires more energy to produce. Speaking of energy, remember that oil just spiked toward $120 a barrel. Every silver mine in the world runs on diesel. Every excavator, every haul truck, every crusher, every grinding mill burns fuel that just got dramatically more expensive. When energy costs spike and ore grades decline simultaneously, the cost of producing silver increases substantially. And when the cost of production increases while the paper price is being suppressed by algorithmic trading, you create a situation where mines become unprofitable, production gets cut, and the supply deficit gets worse. Silver is now up approximately 150% year over year. Let that sink in. 150% in 12 months. And the mainstream financial media is barely covering it. They are too busy talking about tech stocks and Fed policy to notice that one of the oldest monetary metals on Earth is in the middle of a historic bull run. Now I need to address something that the Heraeus report mentioned because I want to give you the full picture. They noted that safe haven purchases are being offset by profit taking as investors reassess the outlook for further gains. ETF holdings in silver dropped as some investors used the rally to reduce exposure and take profits. The report also suggested that the market response to the Middle East conflict has been less extreme than expected, possibly because of expectations that the conflict will be short-lived. This is where I disagree with the mainstream analysis. Yes, some investors are taking profits. That is normal in any bull market. But who is buying what they are selling? Central banks, Asian retail investors, Middle Eastern family offices. Physical metal is moving from weak Western hands to strong Eastern hands, and that is a transfer that does not reverse easily. The people buying at $5,000 gold and $90 silver are not day traders looking to flip for a quick profit. They are strategic accumulators who understand that the global monetary system is undergoing a fundamental restructuring. Uganda's central bank just announced this month that they will launch a domestic gold purchasing program. This is another emerging market central bank building reserves at $5,000 plus prices. They are not buying because they think gold is expensive. They are buying because they think the dollar is vulnerable and gold is essential for monetary sovereignty. When central banks are willing to pay record prices for physical metal, that tells you something about their expectations for the future. The Dubai trading hub situation is also significant. Dubai is a major refining and trading center for gold with substantial exports to India. But the Middle East conflict has grounded commercial passenger flights, which are often used to transport gold. Thousands of flights have been canceled. Physical metal is literally stuck in transit. This is creating supply chain bottlenecks that are not reflected in the paper price, but are very real for anyone trying to source physical metal for delivery. Let me talk about what is coming next week, because there are some major catalysts on the calendar. CPI data is due tomorrow, March 11th. If inflation comes in hot, which is likely given the oil spike, that could create some short-term volatility as the market reprices Fed expectations. But remember the Hormuz paradox. The same inflation that might temporarily support the dollar is also driving the structural demand for gold as an inflation hedge. You cannot have it both ways. Either inflation is a problem, in which case gold is essential, or inflation is not a problem, in which case the Fed can cut rates, which is also bullish for gold. The fundamentals are supportive either way. The Fed decision is expected March 17th through 18th. The market is now pricing in the possibility of fewer rate cuts or even rate rises given the inflation impulse from energy. But here is what the mainstream is missing. The Fed is trapped. If they raise rates to fight inflation, they blow up the commercial real estate market, they blow up the regional banks, they blow up the treasury market where the US government is running trillion-dollar deficits. If they cut rates to support the economy, inflation runs hotter and the dollar weakens. Either path is bullish for gold. The Fed has no good options, and the smart money knows it. I want you to understand something about the price action over the last 2 days because it perfectly illustrates how these markets actually work. Monday's drop was engineered. The algorithms used the dollar strength narrative to push prices lower, trigger stop losses, and shake out the weak hands. Tuesday's rebound was the real move. The strong hands bought the dip, absorbed the selling pressure, and drove prices back to new local highs. If you sold on Monday, you got played. If you bought on Monday, you are already up $124 on gold and over $5 on silver. That is the difference between understanding the game and being a victim of it. Silver closed the week of March 2nd at $83.98. By Tuesday, March 10th, it was trading at $89.81. That is nearly a $6 move in just over a week. The Heraeus report suggested that silver has fallen below its corrective price channel, which would indicate near-term decline. But here is the thing about technical analysis. It works until it does not. When you have a 13.5% production decline from the world's largest silver miner, when you have oil spiking toward $120, when you have central banks accumulating at record prices, when you have industrial demand from solar and EVs and AI exploding, the technicals eventually capitulate to the fundamentals. And the fundamentals are screaming that silver is undervalued. All right, everyone, that is going to wrap up today's analysis. If you found this valuable, you know what to do. Subscribe to the channel, hit the notification bell, and join our WhatsApp community where I share real-time updates, and we discuss these moves as they happen. The link is in the description below. Also follow me on X, formerly Twitter, for quick takes and chart updates throughout the day. Drop a comment and tell me what you think. Did you buy Monday's dip or did you get shaken out? Are you holding physical metal or trading the paper market? Let us have a conversation about where this is heading. This is Mr. AG signing off. Stay safe, stay informed, and remember that in a world of paper promises, physical metal is the only truth. Peace.